watching Inside the Deal, Healthcare VCs to Watch with Nixon Law Group. This video series spotlights investors who are focused on supporting healthcare innovation and digital health companies, both with their dollars and with their expertise. I'm Carrie Nixon. I'm the founder and the managing partner of Nixon Law Group, and we help healthcare innovators navigate legal and regulatory complexities that are so prevalent in the U.S. healthcare system. Today, I am so pleased to be joined by Cody Nystrom, a partner and managing director at SJF Ventures, where she is an investor and supporter of entrepreneurs who are trying to change the world. She has deep expertise in health tech, and she is absolutely a healthcare VC to watch. So let's get to our interview. Cody, thank you so much for joining us, first and foremost.
Glad to do it. Glad to be here.
All right. So I know that healthcare isn't the only area where you invest, but I know that you do spend a great deal of time with digital health companies, which is, my expertise. So I'm interested in hearing about what first drew you to healthcare technology and why you decided to invest in it.
Yeah, no, great. Yeah, well, that probably dates back several decades ago. I, like a lot of kids, wanted to grow up to become a doctor and even studied Latin for many years, thinking that was like one of those prerequisites to becoming a doctor. And then the show ER came out, and I'm so thankful, but it definitely horrified me in ways that I couldn't imagine on just the level of trauma that clinicians have to deal with in their daily lives. And so had, like a midlife crisis and, in eighth grade of what I was going to do with my life. End up, moving into engineering, which I guess is like just a, little bit of a left, right turn from medicine, but have always had a passion on the healthcare side. And so went into investment banking out of school, and then have been in VC for the last 17 years, where I'm practicing in healthcare, though at a very safe distance from an actual operating room. But I think it was, what I realized is my passion was a lot around preventative health and really the root cause of illness, which of course now has like a name for it, around functional medicine. But it was this idea, because I didn't come from a healthcare background at all and really didn't know much about healthcare, other than just kind of the building blocks of the science of it, that, there were so many things about the way our system, about way patients procured care, paid for care, experienced care, that just to me were very counterintuitive. And so really have spent almost the last 2 decades trying to understand the business behind it all. Because even though, there's so many things that intuitively seem like they should make sense, that is just not the way our healthcare system was built nor operates today. So have, been excited to be part of what's now, digital health, and really all health is including digital at this point, and probably all health is including AI at this point. But to really kind of brick by brick change the way a lot of the healthcare system and the way we pay for healthcare, the way we use healthcare is changed in, a pretty dramatic way, just very, very slowly.
Yeah, it is so funny to me how many people I run across, from VCs to lawyers to founders, who are like, well, I started off wanting to be a doctor, and then I realized that was not for me. And by the way, The Pit, I don't know if you're watching The Pit now, but very much along ER, and
Yeah.
I'm watching it going, I could actually never do this. I could actually never do this. So kudos to the folks.
Yeah, kudos to the brave people who could, and I'm very thankful that these shows exposed my huge weakness in being able to tolerate such things.
Totally, totally. Well, you mentioned preventative, healthcare, and I love that focus. It is apparently going to be a real focus of this administration, which I am happy to hear. New enterprises like food as medicine and just preventive care in general is really encouraging. It's just an encouraging focus to an exciting time to hear about. But so tell me a little more in particular about SJF Ventures. So tell me about your investment philosophy. What stage is a company, you invest in, et cetera?
Yeah. Yeah, so SJF is actually celebrating our 25th anniversary this year. Maybe it's actually 26, but we didn't have the party last year. So we're, been around for a while. Like I said, I joined 17 years ago when we were investing out of our second fund. We're now investing out of our fifth fund, and we'll go raise our sixth fund next year. But we are part of this group, and we were an early leader in this field of what's called impact investing. And impact investing's had probably a lot of names over the years, but that's what's kind of settled on today. And there's now hundreds of funds like SJF that are really in it for the duplicative purpose and no concessions or trade-offs in this goal of achieving market rate returns for your asset class. So we're, early stage VC as our asset class that we can benchmark against, and then impact it for society and environment and the stakeholders, which include, community, employees, the shareholders, all of the above. So that's the class of investing we're in, but really we look and feel like most venture funds. We invest at similar stages, we take board seats, we spend a lot of time supporting our companies. As a fund, we're multi-sector, and so while I spend, almost 100% of my time in healthcare, as a fund, we also invest in climate and resource efficiency, logistics and supply chain, education and workforce, gov tech. So we have other areas where we think that we can drive, great impact and financial returns. And so I've built up a large portfolio across a lot of different sectors, which has been, I think, for us, a really important strategy as the shifting, policy environment across now, 4 or 5 administrations that I've been a part of, and, the fund even more, that we have a lot of sectors and we have a lot of scope that we can invest in so that we're not kind of isolated to a market or an industry that might not be having its best time, in a changing regulatory environment.
That's a great point. I hadn't actually really thought a lot about that before. There are certainly a number of VCs that focus exclusively on healthcare or even health tech, but I hear you. That makes total sense. When an industry is having a tough time, that means the companies within it are having a tough time. So that is a smart way to sort of hedge bets and I presume sort of keep the whole fund more secure and safe.
Yeah. Yeah. No, definitely. Residential solar is not having its day in the sun right now. So it is not an area that, we're going to try to bolster it as much as we can from an industry support perspective. But yeah, being able to flex and also we do a lot of things that we call picks and shovels and infrastructure, where we're kind of, instead of picking a winner in a sector, we're picking something that can be an enabler. And so it tends to have a little bit more resiliency during these periods. But yeah, it's definitely shifting sands for a lot of industries right now.
Yeah, I'm curious, do you view this as potentially a good time for healthcare innovation?
Yeah, I think that I don't know if there's really a bad time. I think that, there's capital markets that have different cycles. And then you overlay on top of that regulatory or political, environments that have different cycles. But I think capital market right now, no doubt that, and we could probably distract ourselves for way too long on this topic, but, it had a very bullish period. Lot of capital flooded the sector, up until 21, the end of 21, early 22. And that just created, a dynamic of a lot of companies being funded, a lot of companies probably being funded at really high valuations. And so then there was kind of a hesitancy, and of course the debt markets, shifting as dramatically as they have, created, 23, 24, a different environment for companies trying to be funded. I think 25, I'm starting to see, you're seeing a couple IPOs come out the gate this year in the digital health space. It feels like it's turning back into a little bit more of an entrepreneur-friendly environment versus completely investor-friendly. But I think good companies are attracting capital. There's still a ton of capital out there. Even if funds have been on the sidelines and not investing for the past couple of years, it's like our job to deploy this money unless we're going to return it back to investors. And so I think that, whether entrepreneurs or founders like this message or not, or it seems easy for me to say on this side of the table, but being more resourceful or having to get further in traction before raising the first round or raising the next round or raising as much capital, I think will be for the betterment of all the companies and the investors alike. I think it just creates a lot more optionality. It allows for the business model to hone itself more into something that's more capital efficient. When you're growing at a really aggressive rate and you're raising capital at the same time, a lot of times it's hard to figure out the noise in the business model, what's working and what's not. So hopefully, a long answer to your very short question is I think the environment is still quite positive and it looks like it's improving. And I think that companies that have endured the last couple of years are probably better off from it.
Yeah, I think I would agree. And on our end here at the law firm, we're seeing more activity. In particular, I think this second half of the year, there was a little bit of a seize up, I think, in the first part of the first half of the year, where people were sort of trying to get their minds around what direction the administration would be going and in what direction the winds were blowing. But I think people have kind of moved past that and are doing their thing. And we are seeing deals funded, and that's great news. That's great news. All right, so I want to tap into a little bit of your wisdom from the past number of years that you've been in this space. Um, I am wondering, do many healthcare and health tech startup founders sort of misunderstand or incorrectly assume things about investors in your experience?
Yeah, well, founders and entrepreneurs are amazing people, and I should know because I'm married to one as well. But founders, I think, are just very different pedigree of people. They are passionate, persistent, will not take no for an answer. I mean, the resiliency is absolutely incredible. They're creative, they're extremely bold, and they put themselves out there every day. And then you think about investors. Investors can be ambiguous and indecisive and calculated and skeptical. It's like all the antonyms of what a founder really is. And quite frankly, just aren't often willing to jump, with 2 feet into the pool when the founder is. And so I think that just the recognition of like it's not personal on either side, that founders are very different fundamentally than investors. But I think founders get turned down a lot, and then investors probably spend a lot of time looking at deals we don't end up doing, and that's all part of the process. I think that is just the way that the right investors match with the right entrepreneurs or right founders. It's a numbers game. You work at it hard enough and long enough, there will be a match. But I think, founders, just keeping in mind that, fundamentally kind of very different people, and that, there's nothing kind of personal in it. It's just everyone doing their job, resulting in, what ultimately is a very long process of fundraising, for probably, hopefully, the best reasons.
Yeah, and I suspect there's a little bit of a checks and balances at play, right, between founders and investors, where, as you described, founders are moving at rocket speed, and investors are like, "What? I don't know. Let's see." That checks and balances, as you sort of alluded to, I think is probably a good thing for the whole ecosystem by and large.
Yeah, and I think that was part of the, 18 to 2021 time period where it was anomalous, at least from my, prior career 10 years before that, where that pace of diligence just got really compressed. And so normally, we might have known a company for a year, been kind of tracking them and watching them, and then been able to do diligence over a couple months. Where those periods were getting compressed into like weeks.
Yeah.
And so I do think that I mean, it could work, and it could work out that you end up finding a great investor and the company did well and everyone's happy. But I think a lot of times the compression of diligence creates more surprises on probably both sides when you're actually in it. And that was just a function of the market. It was really a competitive time and there was a lot of capital. Right now, and the way my experiences before that period is that there's much more time for a thorough review. And I do think that just creates less surprises, which is probably just going to create a better working relationship, going forward.
Sure, and that prior time period, I don't know, 1819 through 2022 kind of resulted in a heck of a bubble with some, real some valuations that were incredibly high. And that made it tough coming out, right? For, the next couple of years, 2023, 2024. Finally, I think hopefully we're stabilizing a little bit.
Yeah,
Okay,
absolutely.
so your team recently invested in a company called what I think is called LovU, LOVU. Is that how they say it?
It's actually LovU, but,
Okay.
I mean, I think that probably a lot of people also say that, and it's probably endearing, but, LovU is how they would pronounce it.
All right, all right, all right. Good to know. So they are a women's health company partnering with OBGYNs. And so I am wondering if you could tell us a little bit about this company, and then really what made this investment stand out to you.
Yeah, well, we're actually under term sheet with another women's health company right now, so this would make 2 in a row for us in the women's health space in the last year, and we did
I
not.
love that.
Yeah, it is. It's fantastic, and we did not have an explicit women's health deal before. We've had a lot of companies that touch women's health in ways, but maybe not with an explicit focus. So, it is exciting. It's an area from like an impact perspective we've been looking at for a long time, and so it's great to kind of see, maturity to the space. Which also we're a Series A, Series B investor, so maybe a lot of the companies that got seed funded a couple years ago are now coming out for their A or B rounds, and that's a great time for us to see them. I think that women's health over the last few years has definitely been a hot space. And I mean, we're a disciplined investor. And so there were some that we really loved, but just the valuations kind of got out from, where we were comfortable investing. But,
Yeah.
kudos to those entrepreneurs and to those founders for creating such exciting companies and attracting that level of capital. So it does feel like the capital is coming, but there's still a lot of things to fix or to edit or improve. And I was excited to hear just today the Gates Foundation said that they're allocating 2.5 billion to women's health initiatives, which is going to be great, but obviously will take so long to deploy that, and nothing in healthcare gets fixed overnight, and this will take decades in order to see meaningful probably changes against. But as someone who's had 2 children, I came to just really appreciate how behind the US healthcare system was in maternity and postpartum care compared to so many other areas of healthcare. And if you think about it, pregnant mothers are just not the group that they've historically wanted to volunteer to do clinical trials. And, for a long
Yeah.
time, like, on-site clinical trials was how medicine was created, how treatments were created. And so that's just not a group that you're going to actively solicit. And, providers and payers were just not really incentivized to do things very differently as it related to a lot of this care. And I mean, and then you think a little bit more, like just 150 years ago, mothers surviving childbirth was considered a win.
Right.
So
Right.
it's like,
Not that long ago.
yeah, yeah, and it's still a huge problem in communities. I mean, so but like that's kind of the frame of reference that it felt like a lot of people had. Well, like just 100 years ago, you might not have lived, your baby might have lived, and it is amazing. I mean, just to think, the how much the mortality rate has gone down for infant and mother. But then it's kind of like, but there's really so much that we can do to support every stage of a woman's kind of life, but particularly, a lot that's been available or maturing around the maternity care space, which is where LovU is. I think what stuck out to us about LovU, well, one, we believe you got to follow the money in healthcare. And so you got to find things that are reimbursable and fit. Like the provider it has to be an easy button for them. It has to be something that's revenue positive or revenue neutral. I mean, there's a lot of things that save costs, but you're going to be in a stack of 100, cost saving ideas. So LovU offers opportunities to providers to be able to increase, revenue and clinical services that they're not able to provide through the LovU platform. And then LovU offers this marketplace of variety of lactation support or pelvic floor support to women also things that are not within that OBGYN's practice. And they want a great referral partner. They want someone who's going to be covered by reimbursement. Again, that's a big thing. It's not helpful to an OBGYN to refer a partner and then, it be just patient pay. And then, a patient gets confused on, how much this is going to cost them. And so things that are reimbursable and that can run through claims and that have, good payment support. And, 5 years ago, a lot of these things didn't have great reimbursement support. And you could probably talk way more on this than I can. But it's just, it's taken some time to get the reimbursement there. And now it's like opening up the access and making sure that patients know these are services that are reimbursable. There's just maybe, a little bit more hoops you got to jump through, and LovU helps with that.
I am delighted that you now are potentially doing your second investment in women's health. It is such an important area, and kudos to you for making that happen. So let's shift. So we talked about a little bit about the importance of reimbursement for companies like LovU. How do you evaluate startups in sectors like substance use disorder treatment, where sort of the regulatory direction, like the policy framework, maybe similar to reimbursement, but just general policy framework is still evolving? And with substance use disorder treatment in particular, it's DEA, it's the Drug Enforcement Agency.
Yeah. Well, I would say, every year, just like, because we got a lot of sectors we can invest across within healthcare, we have a lot of different subsectors that we can look at. And so certainly ones where we think there's going to be a lot of regulatory change or some major, kind of shifts in some sort of, reimbursement policy or availability or eligibility. We may hit the pause button on for a while. We have been looking at substance abuse for quite some time. We don't have anything specific there, but I wouldn't say that we're shying away from it, but we're also not kind of all in on it right now. I would just say, like, globally, that if we, had to like pull back from investing every time there was ambiguity in the regulatory environment, we would never deploy any capital. So it's always, as with everything investor related, a risk reward profile of like, how much certainty can we get? Is it at the 80% level, 60% level? What percent level can we get around something? And then just kind of like make a call on that risk. And there's some risk, that can really, like, if a reimbursement code were to go away, or, all of a sudden half of a population that used to be eligible or covered is no longer, I mean, those are, you can quantify them. And then, it's all becomes kind of math on our side of like, okay, this is a tolerable risk or not. And what's the quantification of how that's going to impact the revenue or the population or the market size? But I would say, that's what we do. That's our job, is to kind of put some, some math around all of that. And I would say right now, there's no markets that we're excluding at all. Medicaid, of course, I think is the one we're watching the most closely to kind of see how the trickle down effects of the Medicaid cuts will ultimately impact the safety net hospitals, and a lot of hospitals that are going to be now, seeing a lot of more uninsured patients, how the individual care marketplace is going to be affected. We have a company that administers ICHRA plans, and so seeing how the individual market may be affected if subsidies roll off, which we don't know yet either, assuming they will. But, I think it's just about taking calculated risks and like good mitigation plans for a variety of scenarios, and just being eyes wide open to those risks going in. But yeah, I would say we're open for business in like all sectors. There's nothing that we're kind of explicitly saying right now that's not some place we would play.
Yeah, I was going to ask you what trends or gaps, like in healthcare and health tech in particular, you're watching closely, but I think you covered that, and that makes a lot of sense. So, okay, before we wrap up, I want to ask you a question that I will frequently ask to VCs. If you could rewind, maybe 10 years of your career, what advice would you give yourself about investing in healthcare?
Yeah. I mean, well, one, I mean, if we can be like very direct on some points, like, yeah, value-based care. I mean, we have like, so this would have been 2015. I mean, I think I started investing kind of debt in a dedicated fashion in healthcare around like 2010 or so. So I think by 2015, there was a lot of talk about how value-based care would represent, let's say 50% of payments by 2020. We are like nowhere even close to that. It's like a draw, and the urgency, I think there was urgency even for a while, even though we were in a very small base, there was urgency around it. I don't think there's any urgency anymore. I'd love to hear your thoughts on that, but it feels like it's coming. Like the ship is turned and they're being added onto the barge. But there's no one that is kind of saying, I'm trying to like get to 100%, value-based care payments anytime soon. Not that we we didn't invest in a lot of companies that relied heavily on that, but I just think that whole kind of, and it goes a little bit to preventative health and social determinants of health and really managing costs versus revenue. I mean, when you're moving from fee for service to more cost and risk mitigation, it's just a different way that payers and patients and providers all interact. And so we're kind of like now stratifying both or straddling both. And there's some inefficiencies to that for sure. But so that would be one thing is like, I think we're very optimistic on how fast that would turn. But from an investment point of view, which is probably less specific to healthcare and more specific to just our stage of investing at the Series A, Series B level, would be that, during that period where there was a lot of capital being raised and, may have been a couple years before 2018, there was kind of this desire by, I would say, collective, the founders and management teams and really like the whole industry to, keep going for the unicorn status. And, there's no reason that, any given company can't kind of be on a trajectory for that type of outcome. But if you build your company thinking that that's going to be the outcome, you build it very differently than if you think that you're going to, kind of, okay, I'm going to grow this to, maybe 20, 30 million in sales and I'll sell it for 150 million and everyone will be happy and that will be sufficient for you capitalize it very differently. And so there are a lot of companies that probably raised a follow-on round, maybe at the C or D level that could have potentially taken their company out to sell at that point in time. And, who knows where you can't rewrite history and you don't know what the exit environment totally would have looked like at that point in time. But I do think that it's created an environment now where there are a lot of companies that have raised a lot of capital and there's a lot of, companies going to ultimately be seeking liquidity where, that if we had probably staged that better as an industry and push for some more liquidity or earlier exits along the way, as opposed to raising, follow-on rounds, it would probably be a different environment today. But these things, yeah, are cyclical, and the next set of companies, like I said, I think will probably be more capital efficient. They might have had some battle wounds from overcapitalizing or not bringing on the right partners from the prior company, so they're going to do things differently this go round. And of course, there are always going to be companies that have the unicorn potential, and those have to be capitalized in a really aggressive way. It's just if every company is capitalized for the outcome, probabilistically, like it just doesn't work because we all know that it's a very few percentage that actually exit at that level. So yeah, I think as we think about companies at the Series A stage, we're always kind of thinking about that optionality. How can we invest and support this business so that it can be successful for the management team, for the employees, for the clients, at a range of outcomes, not just kind of one.
Yeah. No, makes total sense. Makes total sense. Okay, so last question. Where and how can founders best connect with you?
Yeah, email is best for me. I don't know if that's old school or not, but it's C Nystrom, Nystrom @ SJFventures.com. I am on LinkedIn, but I'm not the best about following up there. So probably getting in the inbox is the best way to meet. I usually do go to like the health conference, the HLTH conference in Vegas. So always excited to meet new companies there. But yeah, we're like I said, open for business. We got several more healthcare deals to do in our fifth fund before we raise our sixth fund next year, and excited to meet with some new founders.
Excellent, excellent. We'll be in health too. We're going to do a pavilion there of early stage companies. So we're excited about that. Hopefully, I will see you. But I want to thank you for joining us. I really, really appreciate it. You shared some incredible insights. So thank you for being here. And for the founders watching, again, this guidance is really aimed at, being directed to you to help you as you find sort of the right partner, investor to take your company to the next level. We at Nixon Law Group are here, working with founders at all stages as they grow. We're always creating resources to support founders. So if you're curious, check them out on our website. Follow me on LinkedIn. You can find me. I'm pretty available. So, Cody, anything before we wrap?
Yep, that's great. Look forward to connecting with you guys.
Excellent. Thank you so much. And to our audience, please stay tuned for more conversations with VCs that are shaping what healthcare is going to look like in the future.